So if you're here, you are likely ready to start learning how to trade options and even more so learning how to invest. But in this video, I want to kind of go over 5 of the primary things that you will see when you ever open up your app, and you may see buy, which is you buying a stock, and you may also see the option where you can trade this stock, where you're not buying the shares, you're actually trading it. Okay. And so one of the best things about option trading is that it allows us to play both sides of the fence. And what I mean by that is when you invest in something, right? You buy a stock, what's the primary goal? For the stock to go up. We're not looking for no downside. We're not looking for the stock to come down, because that means our investment is coming down. So this is where you as an investor can hedge a little bit. If you buy 50 shares of Apple and you don't know how to trade, you may know how to invest. You're familiar with how to buy shares in a company, but trading is another ballgame. On this side, you aren't just buying shares. Actually, you aren't buying shares at all, because in option trading, you're not obligated to buy the shares, okay? You don't have to own shares in a company to actually trade. And so if the stock is going up, you have the ability to capitalize on that. If the stock is going down, you also have the ability to capitalize on that. And so I remember seeing a lot of people saying, like, how are you possibly making money if everything is red, if everybody is saying that the market is crashing and things? We are option trading. We're not exactly talking about investing in direct shares, okay? And so in this video, as one of your very first lessons, is I want to give you the 5 primary things that you will see if you open up a brokerage account and you go to a particular asset and you go to what is called the option chain. You will see a ton of stuff, okay? And it may seem like a lot, but everything has a name for it. And when you understand some of the basic terminology for things, you can slowly begin to understand what you're looking at, okay? And so with those 5 things, we're going to do a whiteboard lesson so I can give you an up close and personal lesson. Let's get started. So the 5 primary things that we are going to look at are calls, puts, and then we're going to look at strike prices, premiums, and I guess I can add to that contracts, and then expiration dates. Okay. Now, the contracts will really kind of tie into the premium and the cost of things. And it's also a little bit of calculation there that I want you to understand. For those of you who may went to the option trade, tried to open a trade, it looked really cheap, right? But when you go to pay to actually enter the trade, things shot up. We're going to talk about that. So let's look first at the 2 primary option trading strategies, okay? And these 2 strategies will be, the first one will be a call, okay? And then the second one will be a put. Now, when I say the primary 2, there are a ton of option trade strategies. These right here are what you will call single leg option. Okay, or you'll hear single leg strategies, but this is just where you are playing one direction at a time. You may hear calls and puts referred to as various things, and you may say, okay, so what does that mean, and how does that tie to playing in the market going up or the market going down? That's one of the things that I want to look at with you guys, because you'll hear things as, oh, I got into a call or a put. You may hear someone say, oh, I'm going long on Apple, or I'm shorting Microsoft, or I'm shorting MicroStrategy simply because I believe the stock is going down. So let's look really quickly into the both of these particular strategies, okay? These will be the most simplest ones. And when you are new to trading, and sometimes depending on the level that your brokerage account is on, you will only have access to some of the most simple strategies that there are, which is calls and puts, and some of the safest strategies, which is covered calls, which is a lesson for another day. And let's look at calls. When you get into a call is because you believe that the stock is going up. Okay? All right, you believe it's going to the upside. So if I hear some really good news about Apple and they say, oh, Apple just received, let's just say government investment. We know that when a government invests in something, investors kind of start paying attention to that thing, and you might start seeing the price going up. And so we hear this news and you say, well, I'm going to get into calls for Apple because I know that the price is going up. Or we know that Apple is a growth stock. We know that this is a $1 trillion company, okay? And it can definitely grow as years progress. And so you can get into a call because you believe that the stock will increase over time. You might also hear something like, I'm going long. When you hear someone say I'm going long on a stock, they are talking about calls. They're saying, I believe that this stock is going up, so I'm going long on this thing because I know that the value of this stock is going to increase. Okay, so slight lingo there for you to be able to add. So when you hear someone say they're going long, you know that they are bullish on the stock, and that's the next term, bullish. It means that you're bullish on the stock, so you're going to get into a call because it's going up. Now, let's throw this out there real quickly. You know the animals on Wall Street, right? The bulls, the bears. And then if you go to Wall Street, or if you've seen a photo, the bull on Wall Street. When a bull attacks his prey, it thrusts his horns upward. And so the bull is a symbol of the market going up, just plain turn. The bear, on the other hand, is basically when a bear strikes its prey, it swipes its paw downward. And that is a symbol of the market going down. You hear bullish, you hear bearish, you hear bear market, you hear bull market. All of those things just tie into the direction that the market is going. Really quickly, call, you believe the stock is going up. And if you say I'm going long, or you hear someone say I'm going long, they're just basically saying they're entering calls and they're playing this thing to the upside. Or if you hear someone say I'm bullish on a stock, they're also probably looking to get into calls. Now, just because you hear someone say bullish doesn't mean that they're trading. They can just say, I believe it's going to go up. I'm bullish on it, okay? But this just ties into call options, okay? You get into a trade that is a call when you believe the stock is going up, all right? And one of the best additional ways for you to possibly remember, don't leave the video, okay? But when you receive a call, what do you do with the phone? You pick up the phone, all right? Don't leave. You believe the stock is going down, okay? And when you believe that the stock is going down, you're what? If you're bullish on calls, then you are bearish in puts, okay? And when you hear someone say, I'm shorting something, they're basically referring to puts, or they just simply believe that the stock is going down. So if some news comes out about tariffs, right? I say, okay, I know how tariffs can really impact the stock market. So I am going to short this company because I know that they will have the most impact from tariff being placed on whatever country, because maybe they receive in some type of imports. They get all of their manufacturing from this particular country, right? I know that these tariffs is going to impact them. So what am I going to do? I'm going to short the company because I know that investors are going to say, hey, this stock is probably going to come down because this company has 100% tariffs on it, right? So this here is when you hear I'm shorting, let's just say the market, okay? I'm shorting the market, I'm shorting a stock, whatever it may be. When you hear shorting, it's referring to the stock coming down, and a trader will likely get into a put, or that's their plan if they say I'm going to short. Once again, what do you do with the phone when you are done with your call? You put the phone down, all right? I know it's corny, but listen, I'm trying to give you something to help you remember this stuff, all right? So now let's get to the next part of the lesson. All right, so now we got calls and puts, okay? When you are looking to enter your trade, you will either get into a call or a put. Now, there are tons of strategies here. Now, they have straddles, strangles, you have covered calls, you have carry secured puts, you have vertical spreads, iron conduits, Listen, there are tons of them, but calls and puts are the very basic single leg strategies that, especially if you're new to the game, then you want to focus on single leg until you really work your way up, learn more about additional strategies, and then you are ready to start using them as they align with your account size, your game plan, and your position sizing as well. So let's head to the option chain side of things, okay? Now, when you are trading options, and you go to that particular page on your brokerage account, you are going to see what is called a option chain. Okay, and on that option chain, you're going to see a ton of numbers. Okay, you're going to see something that has strike, you're going to see something that has open interest, volume, you're going to see something called the Greeks, you are going to see a ton of things, but we're not going to get into all of that in the video. I want to look at the main thing that you will see and that will play a huge part in your role, which is either your calls or your puts. The first one we're going to look at is the expiration date. Okay, if you have something like Robinhood, okay, but if you've ever taken the time to look at it and you go to the option chain, you will notice at the very top it will have a bunch of dates up there, and you will be able to scroll and you will be able to probably go all the way out to dates that's in 2027 and 2028. These are expiration dates. When you are trading, okay, something to understand is that these options do not last forever, okay? They do not last forever. Or if I guess I would say don't last forever, they don't go on forever to where you can just let this thing run without ever having to close it out. Now, you are able to get expiration dates that go a year out. Some platforms allow 2 years out, but at some point it's going to expire. So the ultimate goal here is to profit before the expiration date. And another thing, you don't have to hold your trade until the expiration date. You can close that thing out at any moment, but the expiration date lets you know how much time you have for your trade to do its thing, you to make your profits or cut your losses and be done with the trade. Something to understand with expiration dates, okay? The further you go out, the more expensive it gets, okay? Longer expiration dates are more expensive, okay? Now, when you are trading, think of it as you are buying time. Okay, so if today is what, February 13th, and I say I want to get into a trade in Apple because I believe from February 13th, 2026 to February, hypothetically, February 13th, 2027, that's about a year, right? I say I believe that Apple is going to really increase from now to then. That's a full year. That's what you call a leap. Okay, you are getting into an option that expires in another year. You're leaping from one year to another. All right, best way to remember that. And the further you go out, the more expensive it's going to get. Now, if I get into a trade that expires, let's just say next week on Friday, that is going to be extremely cheap. It may cost, let's say, $100 to enter that trade. But if I say, all right, no, I'm going to go further out to 2027, it could cost upwards of $1,000, $2,000. Just all depends on the stock and where you are on that option chain. I'm going to show you guys what I mean by that. Okay, so the further out you go with expirations, the more expensive the trade becomes. All right, but cheaper expiration really do give you that footing to get in the door without having to pay too much. All right, just all about your game plan and all about what you're seeing on those charts to say if this is going to be enough time or if I need more time to let it do what it needs to do for me to profit. And that is going to lead into the next part of the lesson, which is the strike price. Okay, now the strike price is your target. Okay, the strike price, when you go to the option chain, you will see a ton of numbers. If the stock is, let's just say Apple, okay? We're going to do Apple. Now, let's just say Apple is sitting at $100. All right, this is just a number off the top of my head. So let's just say Apple is sitting at $100, and you believe that Apple is going to go from $100 to $105 over time, or at least by the expiration date. Okay, this is your target, so this is your strike price. So what you would do is go to the option chain, and you can do one or two things. You can look for a strike price that is exactly 105, and you will be able to select it. Now let me say this too, the strike prices will give you various like costs. Okay, I'm trying to see how I can keep it as simple as possible. So it will give you various costs, and we'll get to that part of the lessons, which is called the premium. Strike prices will have different prices to enter the trade. Okay, that's be your cost of admission to even trade this particular option. So if this here is a $5 move, you're anticipating a $5 move on Apple to go from 100 to 105. There is a high chance that that 105 strike could be a a lot cheaper than something that you say, I believe it can go to, let's just say 101. 101 strike would probably be a lot more expensive than 105 strike, because this right here is basically saying that it's not valuable yet. It's not quite valuable yet because the stock price is only $100. You got to catch a full $5 move to the upside in order for your option. Well, not a full, but you have to see it climbing. 101, 102, 103, the higher the stock goes, your option goes with it and it gains in value because your trade is going in the direction that you predicted that it will go. And so if you get something that is closer to the current stock price, then that one is a little bit more in value, and you will also potentially see your profits come a little bit sooner. Now, it's a lot that ties into that, but that is just the main concept, okay? So I can't try to cram it all into this one video, but with the strike price that you may see on that option chain, that is just basically your target, okay? And you can have a target for 150 and the stock price is only $100, and you say, I have a strike price of 150 or a target of 150 for Apple, that's just saying 3 months, okay? That is going to be probably a really cheap option for you to actually trade. Why? Because it's so far away from the current price of the stock. It's going to be really cheap to enter that trade because there's a chance that it won't even get that high up, and it could take a lot longer to see profit. I know that seems a bit complicated, but I promise you, as you put certain things together, it will all make sense because unfortunately it ties to additional lessons like in the money, at the money, out of the money, to really understand why something that's 150 target is much cheaper than something that's 101 if the current stock price is $100, okay? But that'll have to be a lesson at another time, all right? Let's get to the next part of our lesson, and this will be the premium, okay? This is somewhere I used to always be confused, okay, when I first started trading. I've been trading for 8 years now, but I've been investing on the stock market since I graduated high school back in 2012. I've been learning since the 10th grade, okay? And as we know, once you hit 18, you're able to start investing on your own account. So I had to wait until I graduated, which was at 17, a little after I hit 18, and I was on the go. All right, so let's look at the premium price. Now, if you've ever been to the option chain and you say, okay, I want to pick $105 strike price, and it says that it costs 59 cents. This is where it used to get me because I'm like, 59 cents is not too bad. And there's this thing called contracts, okay? Let's look really quickly at that. One option, okay, equals 100 shares, okay? That's the contract. So you have your options and give you different methods of remembering, okay? So one option or one contract. If you ever notice, if you're not too new to it, you know that you have the ability to select one contract, two contracts, 10 contracts, 100 contracts, and it equals 100 shares. So you see 59 cents, you say, okay, well, that strike price is only 59 cents. Maybe I'm going to get 100 of them. And you get to the checkout and you're trying to figure out why has your cost to enter this trade jumped up so significantly, because you have to multiply the premium price times 100, okay? So let's go back here and we're going to do 100. It has to be times 100. And the cost will actually be $59, not 59 cents, okay? Now, if you got two contracts, you got 200 shares. You got 5 contracts, that's 500 shares. So how many ever contracts you decide to get on a trade, you will multiply it times the premium cost that you're seeing on that option chart. All right, and that will be your cost of admission to entering this trade. Okay, so let's take all of this off really quickly. Because if you have a brokerage account right now, and you're fairly new to this thing, just go to that option chain, pick any stock, and then look for somewhere where it says options, or it may say something like trade, and it will take you to your option chain. So the premium could be, let's just say 0.50, let's say 0.70 dollar, $2.25. you will select whichever strike price, of course, that aligns with your plan, aligns with your account size and budget for getting into this trade, and you're going to multiply times how many contracts you want to do. So if you do one contract, you will multiply that particular premium price by 100, and whatever that amount is what you will see. Okay, it's $70. This will be $100, and this will be $225. All right. So whatever the price that is listed there for that premium, that is not the final price. You will just simply get to that checkout, and you will see at that bottom it's now $59 because your contract involves 100 shares. Okay, so that's the premium. The premium is the price of admission for entering the trade. Remember, different strike prices will have different values. Okay, so let's just say you have, this is the premium right here. Okay, that's the premium, but your strike price could be something like, let's just say we had 101, we got 103, let's just say potentially 105, and let's just say this here is just about 110. Okay, so this right here, it will look different whether it's in calls or puts, okay, because it's on different sides of the option chain, and it all depends on the platform that you're using, where your calls will be located and where your puts will be located, or sometimes they're like side by side. It all depends on the platform that you're using, okay? You will be able to easily select that you want to see the calls option chain or the puts option chain, okay? You'll be able to see in the money options and out of the money options. Like I said, that's another lesson for another day, all right? Because it's a lot that kind of ties everything together. But these are some of the main things that you will see. Which way do you want to play? Are you bullish on the stock? You're going to select calls. If you're bearish on the stock, you're going to select puts, okay? And the expiration date that you select will be a very crucial part of your trading, because you want to make sure that you have time. You could be 100% right about your trade and you could still lose. And when you look back, you may say it was simply because I didn't get enough time on my expiration date, okay? There has been many times where we've been right about our trade, and then as soon as that thing expires, and let's just say a week later, this thing does exactly what we expected it to do. It hits exactly at the level that we were anticipating. But the problem was we didn't have enough time on that expiration. So the expiration date and the strike price that you pick will play a huge role in the success of your trade. The premium is just all about the cost, all right? A lot of times you will see really cheap options on stocks that don't have a whole lot of volatility, they don't have a whole lot of action going on there. You can find some really cheap ones, okay? Something like AMC or let's just see American Airlines. These are like some really cheap, low volume stocks. They're saying they're always good to trade, to be honest, but you will see different values across the board based on the demand, the volatility, and a number of other things when it comes down to any particular asset on the stock market. This was your very first lesson of option trading, okay? That was looking at the main two strategies, which are calls and puts, and looking at 3 additional things that you will see on that option chain, including the contract. You will always see the premium, and then you'll always see somewhere times 100 or times 200, like when you're getting ready to open that trade and you see the cost breakdown, it'll all be there for you, okay? So these are just some main things that I want you guys to kind of keep in mind. Remember, when you understand certain terminology, you understand how to read these option chains and the details of the option so that you can make an informed decision on your trade, all right? So if you guys want to continue, if you're here, you are pretty much on this page to learn how to option trade. And if you're ready to get started, hey, feel free to ask any question. And this isn't just some things that we'll go over. We'll go over a ton of strategies, how to open trades, technical analysis, reading the charts, understanding how to get a idea of what a stock is about to do next. What levels is it going? Something as simple as support and resistance. Understand the indicators, the whole 9, okay? So that was all that I have for you guys. I genuinely hope you enjoyed this lesson, and I hope to see you guys in the program.